Hey guys, today we want to talk all about the University of New Mexico Hospital System's GSI program. What is this disability insurance program that you have access to? And so if you're a resident or fellow at the University of New Mexico Hospital System, this is for you. So we're going to really break it down today. What the heck is a GSI program? What do you have access to? What's involved? What does it get you? And then at the end, we'll be doing a full breakdown of kind of all the nuts and bolts of the actual policy so you can understand what it is and where it fits in your plan. But if this is your first time joining us, though, welcome. My name is Michael Foley. I'm a certified financial planner and certified student loan professional, and I'm also the son of two doctors. And so, really developed lifestyle creep for our healthcare workers like yourself. And, we really want to help you to be more intentional in your finance through really trying to simplify the complex in the world of finances for you. So excited to break this down with you and hopefully simplify the complex of this GSI program. So thanks for joining. So let's dive in today. But before we break it down, I want to give some background of kind of why we want to use a GSI program, or why we even set this up for your hospital here. So, we've been working with the University of New Mexico, residents and fellows for quite some time now. And before we even had the GSI program set up, when we're looking at implementing disability insurance for our clients, we want to always look for true own occupation definitional language. So if you're not familiar with that language or what the heck that means, we got other videos that we can talk about that. So make sure it's a really important for our physician clients to have true own occupation, or as we call it, true ONOC coverage. And so we want to make sure we're looking at that. But when we're looking at the option, historically there's been kind of 5 big companies that have offered this, that we would historically just shop out and just say, hey, here are the different options on the market for you and which one is the best fit. But regardless, you have to go through a full underwriting process, which is kind of translating means that you have to go through a health screening process. And so if there's any sort of disposition for a disability in the future, they want to know about it. Okay, so any sort of risky hobbies. So a lot of our clients in Albuquerque, do rock climbing or mountain biking. Those are big red flags for disability insurance, as you can imagine, right? But also any sort of pre-existing condition, knee injuries, shoulder injuries, any sort of illness that you have. All of these could they're going to want to know about in that health screening process. And what we were running into is that 40%, I kid you not, 40% of our clients that we were going through that had got some sort of rating on their policy, got an exclusion put on their policy, or they just got outright declined from coverage. And so there was a lot of people that need coverage for their families, but couldn't get it because of X, Y, or Z reason in their health history. And then we had those people that genuinely had a serious health concern that is kind of what we call like a non-starter for looking at disability insurance, unfortunately. And so we've had some of those folks that reached out to us and said, hey, I need disability insurance for my family. What's my other option here? And so that's where it really pushed us to look at setting up a guaranteed standard issue program. And this is where we actually went to all the different companies on the market, and we said, hey, would any of you guys be entertained looking at setting up a program like this for the University of New Mexico Hospital System? And so we worked with Joe Sparkman, who is one of your former GME directors, and he sent us a census of all the residents and fellows at the University of New Mexico. I piled them all together, and then we sent that census to the different companies. And one of the companies, Emeritus, which is one of the core, we call them the Big 5 companies, so they've been around forever, they took us up on it, and they said, yeah, we'll offer a guaranteed standard issue program for University of New Mexico residents and fellows only. So you have to be a resident or fellow. If you just graduated, usually they give you like a few month buffer time. So, but still, it's exclusive to you guys. And so what that allows them to do, though, is it allows them to make their risk determination off of the law of large numbers, as opposed to looking at you and your specific health history, your specific hobbies, or things like that. And so when we operate off of a large, demographic of the university system, it allows them to, balance their risk in that regard, as opposed to looking at your health history. So what this now allows us to do is, regardless of if you have some major health history or something like that, you can still get coverage through this, and you simply have to answer 4 major health, 4 key health questions that are really vague and really hard to say yes to. It's like, are you actively disabled right now and not able to work, or do you have Alzheimer's right now? It's like very out there, health questions. And so as long as you can check those, no, you can. It's a guaranteed issue policy, and they don't ask anything about your individual health history. So it's been such a blessing for so many of our clients to be able to get access to coverage that they otherwise might have not because of a health history or other things. And so that's something that's kind of the history of how we set this up for you. And so, what is it, right? So this is obviously, you have access to getting it, but you're getting access to a true own occupation policy. You don't have to go through any health screenings to get it. You get discounts. So typically all the companies offer at least like a 10% discount is kind of the status quo for most of them while you're in residency or fellowship. But when it's through a GSI, they stack on another 10% discount on top of their normal coverage. So and those discounts stick with you for the rest of your career, which is so cool. So when you get it through a GSI, you get that 20% discount right out the gate, which is awesome. It sticks forever on there, and it's portable. So it's a direct it's a contract between you and Emeritus. It has nothing to do with the University of New Mexico. So wherever you go next, most of our clients don't stay in Albuquerque forever, right? And so wherever you go, it's not tied to the university. We're simply piggybacked on the size of the university, but it's not a formal benefit of the university. So that's why you're not seeing, regular emails, out from GME on this. They did send out some emails out the gate to let people know about the program, but we're not even able to market to you guys through that because of the red tape from the GME department. And so this is something that, it's all word of mouth. That's how this gets around. And so, but now we've had hundreds of residents get access to this program, and it's something that you have the perks of the benefit of because you're a resident or fellow at UNM. So I want to make sure you understand what that is, right? So the other thing is that there's also, the cool thing about UNM is there's 2 GSI programs available. So we have the one with the Emeritus, but there's also another one with Guardian that you guys have access to. So that one started after we set up the Emeritus one a couple years into it. And so now you actually have 2 options to choose from a GSI standpoint. So if you're going through a health screening process and you're in the University of New Mexico, you're doing something wrong, right? We got to make sure that you're looking at these 2 GSI. That should really be the only kind of thing that you're considering are the 2 GSIs, because one of the really key things that we have to make sure of is that if you apply with another company, let's say, a Principal or a Standard, or a Mass Mutual, and you go and apply, and you get declined with them, or you get some adverse rating, that could impact your eligibility for the GSI programs, right? So we want to make sure, so now it's, as an advisor, we have to look out for what's in your guys' best interest. So when I'm, working with a client that's working outside of UNM or any other institution that we have a GSI for, we have to do what's best for the client. It is actually a higher liability recommendation for us to recommend that you apply with a company that is away from the GSI before first applying with the GSI, because what if you get a decline and then I just shot your ability to get access to a program that was a sure thing, right? So it's really, you got to be very cognizant of that, okay? So now we got to look at, from a pricing standpoint, it's all going to depend on your age and your specialty. But what we find is that, typically the Emeritus policy is really pricing very competitively across the board. So it's either the least expensive option on the market, or it's neck and neck with the least expensive option on the market, or it's within a few bucks of the least expensive option. So and you don't have to go through a health screening process that you would with the other ones, right? So you do have the Guardian policy, which is another GSI program that you don't have to go through a health screening process for as well. Guardian is kind of known as the Rolls Royce in the disability insurance world. So it's a fantastic policy. However, it does come with an additional cost, right? And so we want to make sure that you're looking at both policies because they're both true own occupation coverages. And so we got to look at what do we really need in our plan, and this is always the backup to the plan. This is not the plan, right? But it's really important that you're looking at both options, because this could be a really big price difference for you that's going to stick, and this kind of a fixed expense that you have for the rest of your career. So really important to be looking at your different options. So hopefully this is helpful to kind of break down what is the GSI, and our next section we'll be actually looking at a contract together so we can look at the nuts and bolts of the policy. So thanks so much for joining, and we'll be happy to help you if you have other questions questions, feel free to reach out to our team, and we'd be more than happy to run a quote for you and help you understand kind of the nuances of these policies and get it set up for you. All right, guys. So we have an actual sample policy here that I want to actually walk through with you. So this is with Emeritus. This is the GSI policy that you guys will have access to through this program. And so I just want to kind of help translate some of this stuff because I know it looks a little scary looking at all the contract language, but I just want to break down some key things that are important for you to know about with this. Okay. So when we're looking at the actual thing, with the disability insurance income protection amount, a lot of people don't understand that, it's not necessarily just a direct replacement of your income. You actually pay for however much coverage you want them to cover you or pay you if you can't do your job. So this is a policy. This one has 6,000 of coverage. So 6,000 is the match that you can get access to while you're a resident. And then once you're within striking range, we'd consider that within 6 months of graduating, or you have a contract in hand, we can get you up to 7,500 per month of coverage. Okay, so that's the most that you can get while you're resident or fellow. But then once you're outside of the residency or fellow space, they do that calculation a little bit differently, and so you have the ability to increase these things all the way up to 15,000 per month of coverage, and we'll talk about how to qualify for that in a future in a little bit on the contract here, but. It's important to understand, that once you're outside of resident space, this is just obviously most of our clients are not making $6,000 or $7,500 per month right now, and they know that. They know that you're incentivized to become, to finish your training rather than get disabled in training because you'll make more money that way. And so you guys are actually the only demographic that they allow that to happen. But once you're an attending, that calculus changes a little bit, and so then they look at what are you actually making, and then they subtract out any group coverage that you might have through your employer, even if it's probably not something we want to lean on in the financial plan because of the definitional language probably is not up to par. It's still going to count towards your total coverage amount, and then the remaining amount that they have left is what you'll be able to increase your personal policy to. So a lot of our clients might, even that are making 300 plus $1,000 a year, sometimes because their group policies that they can't even opt out of with their new employers are so heavy. And it's kind of, so a lot of these are, not great policies, but they get in the way. And some of our clients can't even get over 5,000 of coverage when they're an attending, which is kind of crazy. So something to really, consider, looking at how much you get while you're in that, that residency, or starting practice limit phase, because that's a nice captive time that they don't really care however much you're making or how much you're going to have. Everybody gets access to that, which is cool. And then the elimination period, this is kind of, you can translate that into waiting period. This is a time frame that you have to wait after you have a disability before they start paying out. So it's 90 days. So that's why we like our clients to have that 3 to 6 months of an emergency reserve to kind of float you for those first 90 days. But then this would pay out from day 91 all the way to age 65, which is pretty cool. So that's a huge sum that could be really impactful for you and over the long term. But obviously, if you have 6,000 per month of coverage right now, that's not going to be worth the same if you have a 30-year disability here, right, in the future. And so that's why we always want to make sure it has the cost of living adjustment rider on this. So this is a feature that will actually go up with inflation. Once you start collecting benefit from collecting your claim on a disability, then every year thereafter, the benefit that they're paying you actually go up with inflation that year up to a maximum of 3%. So if inflation is 2% that year, it'll go up by 2% the following year. If it's 6% that year, like we've seen some of these through COVID, it's going to cap you out at 3% growth, right? But this is just to keep par with, so you have the same buying power all the way through throughout a long-term disability, which is really good. But a lot of people think that the policy itself goes up every year, though, with this rider, and that's not true. So it's really important to distinguish that this only starts at the onset of the disability. So once you actually have the disability, then this rider continues going out. But that's why it's really important to make sure that you're keeping your base benefit in alignment with how much you're typically spending on a monthly basis, right? So if you start spending more, we want to make sure that your disability insurance stays on par with that. So typically we want our clients to have whatever they're spending, in kind of their base monthly expenses to be covered with a true and occupation policy. But and much above that, obviously could be justified. But this stuff gets expensive, and so we got to remember this is the backup to the plan. This is not the plan itself, right? And so we want to be cognizant of how much we're spending on our insurance, because we might want to use those funds for other things in our plan too. Okay. So just kind of running through some of these other ones. Presumptive total disability. This is a disability if you're considered totally disabled. So if you can't, if you have a total loss of speech, hearing in both ears, sight in both eyes, both feet, they have a list here. If you have checked any of those boxes, they're just going to consider you totally disabled, and they'll pay you the full benefit, regardless of even if you could do a part of your job still, right? But so that's a nice deal. Obviously, you have to be under a care of a physician. You can't just self-diagnose yourself as being disabled. Somebody else has got to, prescribe that for you. Can't lie on the applications, obviously. And then these are some of the other features. So in the enhanced plus residual, it's a mouthful here. Residual just kind of, replace that with partial. This is partial coverage that says that if you can't do a portion of your job because of your disability and you're losing income because of that, they pay proportionate to that. So let's say in this example, you have 6,000 per month of coverage, and you can't do, you have chronic pain that makes you pull back to 50% of your time, working, and now you're making half the money. So what they would do in that situation, this rider would allow them to pay you $3,000 per month, or half of your benefit that you're paying for. Right. So that's what that is. You got to have a loss of at least 15% in order to trigger this, but that makes sense, right? Now, the other big one that is called the benefit increase rider. So this is one that allows you to increase your policy in the future. So as long as you're eligible, like we talked about with your new attending income, and you can justify the increase from a financial standpoint, your income, you're making enough, then you can increase this policy up to a total of $15,000 per month of coverage. So that's how much you would be getting tax-free in the event of a disability, right? So it does give you the nice ability to increase this thing in the future as your income and or expenses grow over time, which is awesome. But the reason that this, so the kind of the not the catch to this, but some nuance between this is we used to have a rider that was called the future increase option, and that they came to you every year and they said, hey, do you want to increase it or not? And every year on your anniversary of getting the policy, you'd have the ability to increase it or not, right? But it was a paid option that you had on this contract. But with these new policies that recently came out, we switched over to what's called the benefit increase rider, which still allows you to get the increases that we need all the way up to 15,000 in the future. But it's a free rider, but they make you jump through a little bit more hoops to get the increases. So instead of them coming to you every year and asking if you want to increase it, they're only going to come to you every 3 years. And on the third year, you have to apply and show them how much money you're making at that time. And if you do qualify for an increase at that time, then you have to take at least a percentage of what they're offering you. I think it's usually like 50% of what they offer you if you want to maintain the ability to increase it past that point. So if you can, great. But a lot of our clients too, you get to the 3-year mark, we're either spending more money and we do want more coverage anyways. And so the increase is not a big deal. Or sometimes, like I said, in some instances, your group policy is getting in the way and we don't even qualify for more coverage at that time, right? So it's kind of a non-issue. So I'd rather have a cheaper policy and jump through a couple of hoops on the increases than have something that you have to pay for all the way through, which is nice. So I feel like it's worth the hassle on that. But you also do get an off anniversary increase, meaning that you can increase your policy outside of the 3-year span, but you have to show at least I think it's a 20 to 30% increase in your salary in order to justify getting an increase before the 3 years, or a loss of group disability insurance. So typically, if you have like a job change, that could also trigger that ability to increase your coverage if you want as well. So those are, that's how you have the ability to increase it over time as well, all the way up to the 15,000. But So the last, a couple things here, we have the catastrophic disability rider. So this is one that's huge because this is this is what this does is if you have a catastrophic disability that is essentially says that you cannot perform two or more of the activities of daily living, which are like eating, toileting, transferring continence, right? You can't do two of those. They consider it a catastrophic disability, and they'll actually pay you an additional sum. And for most of these contracts, it's almost double what you would be getting from just your base benefit. So we usually on these policies for 6,000, we'd have a 6,000 catastrophic rider on here as well. So if you got disabled, couldn't do your job, they would pay you the full 6,000 of base coverage. But then if you can't do two of the activities of daily living, they pay you another additional $6,000 on top of that. So we like that because it's a really cheap way of getting a lot more coverage than increasing this base policy, because we want to match this up with your base monthly expenses. But let's be real. I mean, if you have a catastrophic disability, you're likely going to have more expenses down the line for additional things that you might have to pick up. And so that's what can account, this catastrophic rider can account for that sort of stuff, which is nice. So that's something that we always want to make sure we have on there as well. And then last couple of things, obviously there's some exceptions to your policy. So, I'll just read through these. If there's anything that jumps out at you, obviously it can't be self-inflicted injury. It can't be for if you're on active duty, for the military, and there's loss caused by war. There's some other ones that are critical to look at. The big one that we always get questions on is for normal pregnancies. So this is one that essentially if there's a normal pregnancy or childbirth, what was happening is a lot of women were going out and saying, hey, I'm disabled like 90 days before they deliver. And so that would start their 90-day waiting period. And then once they deliver, they would start getting disability benefit, for that time, because they would have a doctor say that they shouldn't be working, right? And so there was there's a lot of getting taken advantage of during that true on occupation definitional language. And so they put an exception on there specifically for normal pregnancies. Now, if you have a complication of your pregnancy, which my mom actually had a complication with her pregnancy, that she actually developed, meningitis during her pregnancy with me. So I guess I turned out okay, thank God, right? But that was she was out of work for some time, right? And so her disability insurance paid her because that was a complication that arose from the pregnancy, right? But that's not it's not going to cover you for like a normal pregnancy, like a short-term disability might or something like that, right? So this is different, okay? And then the last couple things are the pre-existing conditions. So if they're not asking you any of these, health history questions, right? They're not saying, hey, do you have, X, Y, or Z, like they would in a traditional thing, because the guaranteed standard issue application is so brief, right? And so what they do is they put this provision, they call it a 3 and 12 provision. So they essentially say, if there's any pre-existing condition that you have, which is active during the last 3 months. So I translate that into, if you have any sort of pre-existing conditions at all, assume that they're not going to cover you for the next 12 months. So for the next year, they're not going to cover you for that time. From the policy issue date for the first 12 months, assume that don't try to, ask for a claim on a pre-existing condition for that first 12 months. So this is just to catch people that are actively like about to be disabled and want to get this contract. We're not asking the health questions, right? They get the contract and then the company be on the hook for that right out the gate. So think of this as a 12-month hurdle that people will have to jump before they get access to the coverage. So, but after that 12 months is up, regardless of whatever pre-existing condition you have, it's all fair game after that point. So even though they're excluding that stuff for the first 12 months, after that 12 months, it's completely fair game for any sort of disability that you might have. So really, really key point there. And then the last one is the mental health or nervous system, alcoholism, drug abuse. Pretty much any DSM related mental health condition falls into this category. And as you can imagine, there's a lot of fraud going on in this space where physicians were actually writing scripts for their partners that and saying, oh, they're depressed and can't work clinically anymore, and collecting benefit, and then they were going and working, on faculty somewhere and collecting additional income. So there's a lot of fraudulent activity in the mental nervous space, and the disability insurance companies had no real recourse on this. And so, because it's a physician, script saying that they had to follow their contract, so they really got taken advantage of this on that. And so, but they recognize that it's a thing. And so they did limit it to 24 months for the lifetime of the contract. So if you have a mental health related disability, they'll cover you for the first 2 years, no questions asked, outside of obviously having a physician, look at that for you. But the big thing is, past that point, you actually have to be institutionalized or hospitalized in order for them to continue paying that past that point, right? So that's something that is fair, but something that you got to make sure that you're aware of on that. Okay. And then last other things, we do get some clients that are, maybe looking to reside outside of the US. And so that's something that is, something that you can reside outside of the US and they'll pay benefits out, if you're living outside of the US, but only for 12 months. And so if you're get disabled and you're living abroad, they'll send you checks, abroad for 12 months. But then after that point, in order for you to continue getting your benefit all the way to age 65, if you're continually disabled, you got to come back to the States. So that's how they do it. They don't want to deal with all the currency exchange and all that. So, and then the last one that is key is that they can't cancel the policy on you, and they have to, guarantee your rates all the way through. So they can't change your rates all the way through, which is really cool. So as long as you make your premium payments, your rate stays the same for the whole time you have the contract. And obviously, if you want to get more coverage in the future using that benefit increase rider, you can buy more coverage. And obviously that additional amount would be based off of whatever age you are at that time, but you still get all the discounts that you got originally, and you do everything. The only thing different is just that it's a little bit more expensive because you're older at that time. But your original rates that you got, when you first started this contract, those stay the same. So if you got 6,000 of coverage, and let's say it's, $200 per month for you, it will be $200 per month for the rest of your career if you never choose to increase this coverage. It will not go up one penny on you, which is really nice. So it gives us, the ability, and as long as you make that premium payment, they can't cancel it on you. So that's kind of, pretty much the long and short of the contract. So, we'd love the opportunity to kind of break this down with you further and run some quotes if you have questions on this. But in short, we don't need to overcomplicate it. We need to make sure we have a true and occupation policy. We need to make sure that we know that this coverage is going to pay out if you do have some loss because of your job or your income. We got to have a backup plan. This is kind of the outlet until we get you to the point where we have, a nest egg built up that, we can, self-insure for that time and not have to lean on an insurance company. Because trust me, the best time that we can get you to do is when we get you to a point where we have enough that we can cancel these policies, because that means you're financially independent. So looking forward to that time, but feel free to reach out if other questions come up, and we'd be happy to serve you. Thanks so much.